Now for normal computation, I'll start from PBT in normal computation. Now the OCI portion, should it be added or it should not be?
No, so, okay. So you should start from the profit before OCI.
That's what he said.
Right.
For normal computation.
So not profit after OCI.
Yes, I'll start profit before OCI.
Book profit. So when your statement of profit and loss account is there, right?
Right.
And there would be a component of OCI in that. Now that OCI you don't have to consider. So you have to consider profits before OCI.
Right.
That is the starting point. And
Right.
thereafter you have to make these adjustments.
Right.
So if in the OCI there are certain items which would never be reclassified to the profit and loss account, okay?
Right.
That would be added or reduced as the case may be for computing book profit.
Absolutely. Suppose one example, one of the item of OCI is actuarial gain on say gratuity or post-medical retirement.
This is like item number 3 here. Yeah.
Yeah. Now, in IGAP, also there was post-retirement medical benefit and we have been debiting in the P&L and it has been allowed. Now the gain portion is now coming in OCI or the loss portion. Now OCI is maybe loss or maybe a gain. That loss in IGAP is already allowed. Now if I don't get that deduction now, then there should be a disparity between the two. Na?
No, when you say not allowed, maybe you're talking about the normal computation, not MAT. Because in MAT it would have already been allowed.
I'm talking about normal computation.
Yeah. No, normal, Ind AS has nothing got to do with for the normal computation, of course, you will go as per the profit and loss account. That is the starting point after Ind AS. For MAT purposes, you have to start before Ind AS, before OCI. But for normal computation, it will be after OCI.
After OCI?
After OCI, yes. But then you will have to make adjustments in relation to those expenses or losses which are not in accordance with the provisions of the Income Tax Act.
Vaish, this OCI is before appropriation or after appropriation?
Appropriation would be in any case outside the purview of MAT computation.
No, if you see 115 JB,
Yes,
subject to correction,
yes.
when they talk of certain adjustments, it prima facie appears that it is after appropriation, because when they are talking of reserves and all that. So if present law of 115 JB talks of starting point to be after appropriation, then what is the reason for you to conclude that the book profit 115 JB should be before OCI?
You see, it is whether before or after, it does not matter for the simple reason that the adjustments which you have to make while computing book profits are to the extent specified in this table, right? So therefore, if you take the profit which is after OCI, as a starting point for MAT, now there could be items which would not qualify for book profit purposes because they would be reclassified, let's say, at a later date to the profit and loss account, or let's say they pertain to items like PPE or equity instruments. Now you will have to eliminate the effect of those while computing book profit. So,
no, I agree. My only limited observation was that the moment you conclude that for purposes of 115 JB, you start before OCI,
right.
Therefore, you are concluding that all the appropriation items, whether debit or credit, are to be ignored for the purpose of 115 JB.
No. I think I'll put it differently.
No.
Yes.
Whether you start with profit before OCI or after OCI, you have to analyze the composition of OCI. Right?
Correct. That's right.
So therefore, you have to make adjustment to the book profit for the elements computed or comprised in OCI.
Absolutely right.
If you start with profit after OCI, the adjustments will be in a certain manner.
Correct.
If you start with profit before OCI, it will be in the reverse manner.
Absolutely right,
So
sir.
that you will come to the same result. The result will not be different.
No.
Except in one case, if the adjustment is positive, in the other case it will become negative. That's all that will happen.
No, it's not. It's absolutely right, sir. My apprehension is that in case you are going to start with a figure before OCI,
Right.
the foregone conclusion is that the appropriation items, whether debit or credit, has in any case to be ignored for the purpose of 115 JB, which may not be correct.
No, OCI, still have to.
No, OCI is all right, sir. I am not disputing about the OSI, which Rupesh has said, whatever are the items forming part of OSI, either they have to be ignored or has to be
So
adjusted.
therefore, if you start with the book profit before appropriation, obviously you will not add back any appropriation to reserve because there is nothing in that item. But if you start with the profit after appropriation, then you will add back whatever you have appropriate to reserve.
So because insofar as reserves, appropriations are concerned, you know, the situations remain the same. So it is governed by the explanation to 115 JB. Now, if reserves, if you make appropriation to a reserve and your starting point is the amount after that reserve, right, the net profit after the reserve, then you will add back the reserve to the book profit. But if your starting point is before the appropriation, then you are not required to add back anything because it is already included in the profit and loss account.
OCI is after current tax and deferred tax? Or before?
No, it's a separate item altogether.
No, it is before or after?
It is after that.
After current tax, deferred tax.
If it is after current tax, deferred tax,
Yes.
then before this item there is a MAT credit entitlement also. Okay?
There is a MAT credit,
Entitlement.
right?
So if MAT credit entitlement is there, if you are starting after this current tax and deferred tax and OCI, then before this there is a figure of MAT credit entitlement. Okay? After you start from this figure, 115 JB doesn't permit you to reduce that figure to the extent of the credit in the P&L on account of MAT credit.
No, I think the credit or debit would be for deferred tax asset or deferred tax liability.
But MAT credit entitlement is neither deferred tax asset, neither deferred tax liability.
So deferred tax asset and liability in any case excluded.
That is excluded,
Yes.
but MAT credit entitlement is not covered.
MAT credit. तो P&L
Yes.
तो अलग आएगा.
Because whenever you are making a provision for tax, even you are calculating the book profits tax is so much, less entitlement, balance figure goes to the P&L account. So only the current tax goes to the P&L account, otherwise MAT entitlement never goes to the P&L account.
It goes, sir. There is a separate line item. There is a current
So
tax.
that is only for the adjustment, plus minus, that's all.
But if 115 JB says you please adjust current tax, and there is no reference of MAT credit. So if for the purpose of 115 JB, if you are going to start before OCI,
Your net tax is the tax, that's all.
you can't say that net tax is a tax. There is a separate debit of current tax, there is a separate credit of MAT credit entitlement. If you can argue to say that MAT credit entitlement is permissible to be reduced from Schedule 6 profit, then it is a separate argument.
It might not be the case, but I'll get back to you on this. To the best of my information, MAT credit is not forming part of the profit and loss account. But if it does, then it needs to be excluded because tax you don't get deduction for payment of taxes, and MAT credit is no different from payment of tax. So I don't think that you will get deduction for it while computing book profit, assuming that you can debit it to the profit and loss account. But I'll get back to you on this.
See, I think you are in that sense on the debit side providing higher tax, and on the credit taking the MAT credit. That may be admissible. But ultimately you have to net off the two. I don't think just because 115 JB explanation does not talk of adding back the MAT credit that you can, say that there is no adjustment. Ultimately your current tax will be the gross tax minus the MAT credit. That will be your net outflow only. That's only a matter of presentation that you are putting it on the two sides of the profit. Yeah. Right. I would think so.
So this is the reference years for the first time adoption of adjustments. So companies adopting Ind AS with effect from 1st April 2016. The first financial statements would be made for 16-17. Comparative period would be financial year 15-16. The opening balance sheet would be prepared as on 1st April 2015. The first time adoption adjustment as on 31st March 2016 considered for computation of MAT liability. So these provisions are applicable from 1/4/2017, that is assessment is 17-18. In other words, they are applicable to the current financial year. So you have to take the figure of transition into consideration as on 31/3/2016 or 1/4/2016, because these provisions become applicable from the current financial year. So while computing your advanced tax liability, you will have to factor these adjustments which have now been specified in the Finance Bill 2017. Yes. Yes. Okay. Okay. Sure, certainly. We'll do that. We'll keep that into mind. Thank you very much.
I think, Rupesh, what you can also elaborate is the interplay between ICDS and this INDAS. How is that going to play out?
So, okay, yeah, the only thing is that ICDS would not impact MAT because it is not part of your profit and loss account. So ICDS is outside the purview of MAT. So
No, but your profit and loss will have to be prepared as per INDAS.
Right.
And your income tax computation will also, normal computation will also go by ICDS.
That's right. That's right.
So you will, to that extent, discard probably what is there in your profit and loss account prepared as per INDAS to factor in.
You will have to, of course, because to the extent there is an overlap, to the extent that there is an inconsistency or there is an overlap between ICDS and INDAS, ICDS would prevail because that is in relation to computation of normal income. And if there is an adjustment which is already factored in because of INDAS in the accounts, and you are taking that as a starting point for computing your income, and it is also specified that you need to make this adjustment because of ICDS, you would ignore because it has already been factored in. It is not that you have to do a double impact, first by way of INDAS and then again by way of ICDS, because it is already captured in the books of accounts, the adjustment which was required because of ICDS. So there will be no double impact, and you can always eliminate the double impact.
But for the companies adopting INDAS, as you correctly said, the adoption period of 1st April 2016.
Yes, yes.
31st March 2017 is on the anvil. The MAT certificate format also to record all this will undergo change in the near future. That will be published before the date of the return at least.
Hopefully, yes.
Otherwise, then the recording of the adjustments and the certificate of the accountant has to be
Right.
compatible.
So then some amendments related to international taxation. So under section 911, an amendment was made with retrospective effect from 1/4/1962. An explanation 5 was inserted, which said that in case of indirect transfer of assets, and if its value is substantially derived from India or assets located in India, then there would be a taxation in the hands of the non-resident. Now this was resulting in difficulties insofar as FIIs and FPIs are concerned, who have various small investors who make investments, and they were getting impacted, and it was resulting in double taxation, because there was taxation first at the point of time when the FPI or FII would sell the share in India, there would be capital gains, and then when the same income is distributed to its investors overseas, who would be very small investors, they would also suffer tax if these indirect transfer provisions were to be made applicable to FIIs and FPIs. So there was a lot of representations which were made to the government, and the government has now clarified that these indirect tax provisions, indirect transfer provisions would not apply to FIIs and FPIs. But this is only in relation to category 1 or category 2 FPIs and not all FPIs. So there would be certain FPIs which would not be in category 1 and 2. Those are not covered, and they would still be impacted by these indirect transfer provisions. Okay. Another amendment which has been made is that an explanation 4 has been added to section 90 and 90A to provide that a term which is not defined in the DTA but is defined in the Act, it shall be assigned the meaning as defined in the Act or any explanation issued by the central government. Now, as you are already aware that in the DTAs, there is a provision, article usually 3(2), which says that any term not defined in the DTA would have the same meaning as it would have in the domestic law. So to that extent, the first part of this provision is fine, because that is what is also there in the DTA. But then it says that in case of a term which is not defined in the Act, it shall be assigned the meaning as defined in the Act or any explanation issued by the central government. Now presently under section 90, there is also subsection 3, which says that central government has the power to come out with a notification to define a term which is not defined under the Act. Now, what is not clear to me is that if there is already a provision, that is subsection 3 of 90, which empowers the government to come out with a notification to define a term not defined, why was it necessary to have this explanation? Perhaps the only reason which I can think of is that the ambit of this explanation is wider than 93, because under 93, the company has to come out, the government has to come out with a notification, whereas here, any explanation issued by the central government is already covered. So if tomorrow government wants to come out with a circular explaining the meaning of a certain term which is not defined in the treaty and not defined in the act, then perhaps that circular would become the definition of that term as per the provisions of the act. So maybe to give more flexibility to the government to provide clarifications or to come out with explanations as to what the government thinks for a term to be interpreted, this provision has been incorporated. Otherwise, I thought powers were already there in terms of subsection 3 of section 90. Now,
But I think it will still raise the same issue, that
Yes.
whether by a unilateral notification, explanation, circular, you can override the provisions of the treaty.
right. So, there are several decisions of several high courts, New Skies, Delhi High Court and several others, wherein the courts have laid down that any unilateral amendment in the act cannot be read into the treaty. And those decisions were rendered in the context of explanation 5, 6 and 7 of 916, by which the scope of royalty was expanded. So that argument, to my mind, would still be available, that whatever clarification the government comes out in relation to a term for the purpose of the act would be confined for the purpose of the act and would not travel to the treaty. And also, if the explanation or the clarification or the meaning which is given by the government is expansive, or it is not in the context in which the provision was incorporated in the treaty, it would be subject to challenge to our mind. We can say that this is not as per the Vienna Convention, and it is not in the right spirit. Now quickly I'll go on to the provisions related to income from other sources. So very important amendment which has been made in section 56.277A by bringing in a new clause 10 from 56 and in 56.2 is that presently the provision is in relation to individuals and HUF, if you receive certain properties and those properties are specified above rupees 50,000 or without consideration, then it is considered as income in the hands of the recipient. In relation to the companies and firms, the law is that if you receive any shares of a company in which public are not substantially interested, where the value is more than 50,000 or for no consideration, then it is treated as income of the recipient company or firm. Now, what has been now provided is that those provisions which are there already, that would be applicable only up to 31/3/2017. From 1/4/2017, if you receive any person, first of all, any person, that is individuals, HUF, companies, firms, trusts, any person on the earth, receives any property. So earlier, the property was confined to 5 or 6 items in relation to individuals and unlisted shares in relation to companies. But now any property received by any person where the differential is more than 50,000 or it is received for no consideration would be subject to tax in the hands of the recipient. So this is a very major change, and it would plug the loophole which was there in law present, by which tax planning could be done through the medium of the trusts, because trusts could receive shares or other properties, and they were neither in the ambit of individual or HUF, unless the beneficiaries were all HUF or all individuals, and they were neither firms nor companies. So they did not fall in the ambit of the present law, but now they would also get caught, and this is this will have very wide ramifications, because the provision is all pervasive and covers all persons and all properties. So this is one of the major amendments which have been made to curb maybe misuse of the provisions.
In case of private trust for the succession planning, so when a person gives the assets to the trust and the beneficiary of the trust is relative, so whether it will be deemed as a transfer to the relative or the transfer to the trust, because the trust is a fiduciary capacity holding the assets. So whether they will apply the provision of the trust is a separate person and it will be taxable in the trust, or it will be treated as agent because the ultimate beneficiary is the relative.
So I would think that if the ultimately beneficiaries are relatives, are individuals who are relatives, and there is no discretion available with the trustees to change the beneficiaries, like by including non-relatives or persons other than individuals, it would still be possible to argue that since they are relatives, and if you were to remove the curtain of the trust, then it is basically the benefits go to the relatives. So the benefit, it should not be taxed on 756. It should be possible to take that argument in this kind of situation.
Just to supplement, in case the trust has the clause to amend the trust also, so the trust has to be a non-discretionary trust, and only the related